Good morning from London. I'm Guy Johnson. I'm alongside Kriti Gupta. We are an hour away from the opening trade. So what do you need to know? The risk rally rolls on. The latest economic data shows the American economy is not slowing rapidly. Oil slides as the US indicates that Israel has accepted a ceasefire proposal. The US Secretary of State Tony Blinkin now heading for Cairo and Doha as efforts mount to persuade Hamas to accept the deal. And expectations are high that Sweden's central bank will deliver another rate reduction this morning. This is Finland's Rehn signals he's looking at another ECB cut in September. Kriti.
In the meantime, a quick check on these markets. A little bit of divergence when you're looking at the futures picture. Your Stoxx 50 futures marginally in the green, but the underperformance you're seeing in the FTSE is where you want to keep your eye on, down about 0.3%. In the currency picture, slight weakness there as well, but still sticking to that handles that we're keeping an eye on. 110 on euro dollar, 129 on cable. The countdown to the opening trade starts right now.
Tuesday the 20th, good morning. Let's talk about what's happening out there in these markets. The risk rally rolling on. The S&P is on its biggest tear this year. We have been up for many, many sessions. Feels like the 1st of August, the beginning of August, not the 1st of August, beginning of August, a distant memory. The US economic data looks solid right now. The NFIB data, the latest set of data we want to talk about. Look at what's happening in Japan this morning. Equity market there on a decent rally as well. Europe's looking a little bit more cautious, as Kriti has been indicating. But Kriti, the data are okay. This is the message that we're getting right now. The NFIB survey signaling small businesses are actually seeing some acceleration. It does feel slightly as if that print that we got into the payroll print that we got feels a little erroneous. It feels like it didn't tell the message of what's happening in the US economy, because all the other data stacking up to paint a different picture.
Well, it was the ultimate argument at the time that we were talking about. Is this an actual sign of weakness, an actual sign of recession, or is this some sort of normalization? I think we've got our answer here. This is normalization. This is kind of going back to a pre-pandemic normal where stimulus is coming out of the system a little bit and people are still able to swim. I think the difference, though, or the hiccups that you're seeing might be, even though some of the data on the business side is showing strength, the consumer numbers are still a little bit weak. You're still seeing people kind of feel that wealth effect, that even though they're doing fine and wages are rising, the mentality isn't quite there.
And that feeds into the politics. We're going to talk about that in a little while. But the fact that the market has come out, equity market in particular, risk assets in particular, have come out and rallied this strongly is really... It's really quite amazing. I think it's probably driven a little bit by the fact that, A, you've had a big sell-off, you've had a position clear out, the market is set up a little bit better, expectations are a little bit lower, and then you get some decent data that kind of augments that, and that has propelled these markets really strongly out of the hole that they generated at the beginning of August.
Yeah, and I think what's really interesting here is what happens next month, right? Because seasonally, September is actually the negative month. That's the one where you start to see the corrections, except we kind of front-ran the correction. That 10% drop that we saw in the S&P 500, we're seeing some green on the screen now, but how many traders are actually at their desk? This is low volatility, low liquidity. Does it then reverse when more folks are back in?
Here's my question. There seems to be, and I read a lot of copy that seems to suggest this, that the risk rally is being driven by the expectation that the Fed is going to deliver rate cuts, that we are going to see a significant number of rate cuts being delivered, and as a result of which we can change our kind of basic arithmetic around how we discount assets. If the data are okay, are we overestimating the number of rate cuts? And is that a market negative, or is better data, is good news good enough news to keep the risk rally on track? And I don't think we're going to know the answer for that for a little while yet.
No, it's a fair point, though, that the tailwinds for the stock market are essentially coming from the rate cut story, as you point out. But
are they? That's the bit I don't know.
It kind of feels like that seems to be the argument I'm hearing, is simply because the earnings are actually slowing down. That's been the argument that you heard from Deutsche Bank. We heard from BlackRock, from Kareem Tradid.
But the data are okay. The economic numbers. Let's exclude the payroll. Story. The rest of it's okay. And is that what is giving people confidence that actually we're not heading to a recession? Is the market more scared of a recession than anything else? Because that's what the payroll number seems to suggest.
Right. So what's in the driver's seat, the earnings story or the economic data? I don't know. We'll find out in September for sure. But at least that's the U.S. story. I think for the European story, it very much is a data-driven kind of set of pictures. And I think Rehn made that comment, I want to say yesterday as well. This, of course,
he's in New York,
the Finnish central bank talking about that there are growth risks. And we've been talking about this, I want to say, Guy, for a couple of years now. And I think the resilience in the States was largely expected. The resilience in Europe feels feels like it's catching everyone by surprise, but the case for a September cut seems to be basically etched in stone.
Ollie Rehn is certainly getting on board with that idea. There are hawks, certainly in Germany, that seems to suggest that actually the labour market is strong enough, that the consumer is strong enough, that inflation is still not actually done and dusted as a risk that we need to take off the table. Just had PPI data out of Germany. The manufacturing side we know is weak, and that's come through pretty much in line with expectations at 0.2. But there are certain, and the Germans are certainly painting a picture of we don't know yet. But others around them in the other orbits are certainly seeming to suggest that. And we're going to get a rate cut as well outside of the Eurozone this morning, it looks like, from the Riksbank.
At least that's where the markets are positioned, certainly. And I think this is interesting, though, because even though we're talking about the manufacturing sector and the weaknesses, well, I'm going to push it forward again to September because, again, very few people are at their trading desks right now, just given the summer light liquidity, light volume thing that we're talking about. But in September, you start to see a couple of other issues come up as well. And I think a lot of that comes out of France. We're putting so much effort on Germany, but France is about to have kind of a little bit of a reckoning, not only with if we do get a new prime minister, whenever that actually happens in France. But then also you have those EU deficit conversations. Those deadlines come up in France as well. If we're talking about budget issues, fiscal spend issues, a lot of that comes to the forefront in September.
I've got a little list of European politics that we need to worry about. August 23rd, you've got this French government kind of conclave. You've got a new commission, the deadline for the new commission, I think, names in the hat by August the 30th. So September's going to be a story there. September the 1st, we get some big German elections, particularly in the east. The right... Yeah. The right could do very well there, and that is kind of similar in terms of the political earthquake that we've seen in France. Maybe you get a similar political earthquake happening in Germany as well. So there's definitely political risk at the beginning of next month. Talking of kind of the geopolitical risk and what it's doing to markets right now, have you seen oil? Oil's been under quite a lot of pressure. Maybe we take out some of the risk. There's been this premium built into the oil price because of this concern that we're going to see a significant escalation of tension with Iran at the centre of the story. But if we get a Gaza peace deal, does that take some of that out? Do you need to take some of that out? Because the thing that's really sort of hanging on oil right now is China and the really weak growth data that we're seeing there. That's kind of acting as a brake to the upside. But you take off sort of that's the wrong word to use, but the stabilising effect of tension in the Middle East in the oil price, you could see some significant downside. That seems to be being priced in now. You mentioned the brake to the upside on China. The other piece of this is the massive amount of supply coming out of the States. You will still have that kind of a ceiling that's put. And I think that's what's affecting what you talk about, that geopolitical premium. The spread between Brent and WTI right now, $3 and change. Traditionally, when you see these tensions rise in the Middle East, it goes anywhere from $4 to $6. And we've historically been under that range. I think we've got a 5-day chart, which you brought to my attention this morning, actually. This is a little bit of a mini correction in Brent crude in just the last 5 days. I'm curious, though, how much of that is the fundamentals and how much of that is a little bit of macro tourism, as our friend Cameron Christ will say over in the States, when it comes to oil used to be a hedging inflation kind of bet, and now it doesn't seem to play that role in portfolios. We'll see what Tony Blinkin can do on the geopolitics front. I think he's heading for Doha. I think he's heading for Cairo, then Doha, to try and figure out the Hamas side of that equation. Looks like Israel maybe has signed up to the peace deal. We'll maybe look for some news on that a little bit later on. In terms of what else we've got coming up on the show, plenty that we need to discuss. It may be August, but there's lots of things going on. We're getting an outlook for the European economy. Royal London Asset Management senior economist Melanie Baker is going to be joining us. Mercer's Emo Walsh is going to be up a little later on. We're going to talk markets there. Plus, we're going to break the Riksbank decision with Matthias Persson of Swedbank. We'll get his take. He's actually thinking, you know what, the Riksbank needs to deliver a 50 basis point cut. He thinks the Swedish economy is slowing rapidly. So we'll talk about that a little bit later on. Is 25 going to do it? And then we're going to take a look into the global risk picture. Virginie Maisonneuve from Allianz is going to be joining us later on, Kriti. It's a busy-ish kind of a day today. You've got the Riksbank, got a few other things. We're obviously still beating to the kind of the back end of the week when you've got Jackson Hole and you've got the BOJ story as well. But plenty of data to watch in between them. Some of that kicks off at least today at 10 a.m. UK time. We got that Euro area CPI data. I believe it's a final reading, though, so we'll actually see how much of a market mover it is. And we talked about the Riksbank, but at 12 p.m. we also have the Turkish rate decision as well. So if you've got your eye on that inflationary story, we know there's been some turnover, of course, at the helm of that bank as well. And then this feels like this might appeal to the dad in you. We've got those Lowe's earnings before pre-market in the U.S. session. Remember, Home Depot's numbers last week were not great. Walmart's numbers as well. How much of that feeds into Lowe's, although it is seen as a little bit of a more expensive version of Home Depot. We'll see if that feeds through. DNC day 2, of course, politics still very much in focus. But I think it might come back
to Bostic and Barr, especially as you say, we are counting down to Jackson Hole and, well, I guess we're in Jackson Hole, but counting down to Powell's comments on Friday. Already, though, you are seeing a little bit of division. Bostic now actually on board of a little bit of a rate cut, even though for a very long time he said that he's not on board. He still wants to see the data. It kind of seems he's been changing his tune lately.
It's really interesting, isn't it, to see how the dust is going to settle on this one and how the hawks are going to be positioning. There is evidence of labour market slowdown. There is evidence that maybe the inflation picture is coming under control. But this doesn't feel like it's an economy that is slowing quickly still. We're not getting this sort of rapid deceleration. And that's always been the fear, that you let the labour market get out of control, suddenly you go from a 3 to a 4% unemployment rate, and then suddenly you're off to the races. And that's always been the fear. But actually, other data are not painting that picture. So I think caution appears. The word I keep hearing from central bankers is caution. We're going to do this, but we're going to do it slowly. There's no rush. There's no need to do this aggressively. It was only a couple of weeks ago we were talking about emergency rate cuts. I think that feels a little erroneous. It
does, but the argument against that, and that's really where you kind of have a little bit of deja vu around Fed credibility, is that if you wait too long for the cuts, and I think that's where the shower metaphor seemed to come in with Austin Goolsbee yesterday, where he was saying, look, if you've got to turn up the temperature, there is still tightening that's going yet to show up in the economy. So if you cut now, that will still take some time, and it's unclear what that delay actually looks like, given this post-pandemic normal.
He's obviously spent some time in British showers. They're rubbish.
I think they're rubbish everywhere, no?
No, they're not. There are places where the water pressure is OK. This is not one of them. Let's talk about what you need to know this morning and figure out what else we need to watch out for. The British tycoon, Mike Lynch, we understand, is amongst those missing after a luxury yacht was struck by a tornado on Monday and sank off the coast of Sicily. Sources say Lynch and his wife were celebrating following his acquittal from fraud charges in the United States. The World Health Organization says Burundi has reported 100 cases of Mpox caused by a fast-spreading subvariant that has triggered an outbreak in the DRC. The cases, 28% of which were in children under 5, have been reported since July in multiple districts. And the US President, Joe Biden, has called on Democrats to rally behind Kamala Harris as his party's convention kicks off in Chicago.
Selecting Kamala was the very first decision I made when I became our nominee. And it was the best decision I made my whole career.
Bit of history being made there, the torch being passed firmly from one to the other. President Biden backing Kamala Harris, talking about what she is going to deliver, but she's going to deliver in some ways some of what he's delivered, and there's going to be a continuation. It wasn't in what she said yesterday. It was a surprise to hear from her, but apparently she's still going to push through with this tax hike, corporation tax hike that he's pushed through. That looks like it's going to be on the docket as well. Looks like we're going to be continuing with that story. What else is going to be there? There's this huge fight coming up with U.S. taxes and corporation taxes.
There absolutely is, but it's something that Joe Biden, I should say, promised in his first term as well, and we haven't actually gotten there yet. And that was something that even the markets had priced in the last election. And again, we hadn't actually gotten there. And a lot of that had to do, of course, with the fallout of COVID and the higher interest rates. And, of course, the timing of that really mattered. Can Kamala Harris deliver? The other piece of that, the extension of the other policies that we've been talking about, has been the price gouging story. She's talked about it a lot with groceries, and that's, of course, been coming with mixed reaction when it comes to, of course, economists and really people who are listening to her as well. But that's an expansion as well of President Joe Biden's kind of drug and Medicare policy as well. On top of that, I thought what was interesting at the DNC was we got comments out of AOC, who's an up-and-comer. She's a congresswoman coming out of New York. She's very vocal around the ceasefire, among many, many other things. Very pro-union as well. But she really made the point that Kamala Harris is going to be the one who gets that ceasefire negotiation across the finish line. Like, look, she was rallying up the crowd, but this has been the Achilles heel of Joe Biden. We'll see if Kamala Harris is able to turn voters onto her side, where Biden and Trump, by the way, has not.
Some key districts in play as a result of that. Does that mean Tony Blinkin stays on for a while? Does this happen before November, before January, in terms of getting that deal across the line? I don't know. Key personnel, obviously, in place right now. Do they continue in some of their roles for a while? maybe to get this over the line.
And we had that conversation yesterday with Brett Bruen, of course, the former Obama admin of global engagement, talking about Phil Gordon being perhaps a carryover from Joe Biden's administration, among many, many others. That's going to be a conversation we continue to monitor. But coming up on the program, we're going to go back to the central banking story. Bloomberg expecting the Rick's Bank to resume interest rate cuts. We're going to break the decision at 8:30 a.m. UK time. Plus gold steadying near a record high. We're focusing on bullion as traders await Jay Powell's speech later this week. But up next on the program, equities still riding that risk-on sentiment. In Europe, I should say, taking a little bit of a pullback. We're discussing what the markets are going to be navigating next. Get a part of the conversation. Join us and just type in IB plus BBTV Go and get involved. Stick with us. This is Bloomberg.
The Fed has a real opportunity here to sort of shift the narrative. And I would argue that they're starting that process now. You know, when Powell finally shifted to focusing on labor over inflation, which I would argue was long overdue, I think that's step one. And I think the next step is, hey, look, we don't think that things are really sort of slowing in a notable way, but we recognize that policy is calibrated for a completely different inflation regime than what we have right now.
PGIM's chief US economist Tom Porcelli talking to Bloomberg yesterday, talking about what we're seeing in terms of the data. It's not rolling off a cliff right now. We're not falling off a cliff. The data's kind of slowing down a little bit. You've seen the latest data coming out of the NFIB, the small business survey. It looks okay. Actually, in some cases, the data points to small businesses seeing a slight acceleration in the economy. So actually, the data in its totality, because apparently, according to the Fed, we have to talk about the totality of the data, don't paint that blacker picture. Melanie Baker, senior economist at Royal London Asset Management, sitting around the table with us this morning. Do you agree with that? Is that the kind of the right way of thinking about it? The payroll number a few weeks back gave us all a big growth scare, but the rest of the data don't tell me that.
That's absolutely right, I think. If I look at the data across the board for the US, it's just very mixed. I don't really see signs that the US economy is sort of falling off a cliff here. I think there's support for expecting a kind of what I call a soft patch in the US economy in the second half of the year, but nothing that's overly concerning me. There are, a few genuinely worrying data points, but on the whole, I think it's a mixed, reasonable picture for US growth.
So I keep asking this question. If I get 25 basis point cuts, that basically just signals a soft landing. We can manage this process. We don't need to do a lot of them. The data aren't rolling off a cliff. We are in control of the process rather than the process being in control of us.
In terms of the Fed, I'm not expecting them to panic. I don't think there's any cause for that, and that's certainly not what we'd sense looking at recent Fed commentary. Certainly not what I'm expecting from Powell, absolutely.
Yeah.
What does a red flag look like, though, when we come to the U.S. economy? I mean, it feels like for so long we're talking about this payrolls hiccup. The minute we see weakness in payrolls, that's the signal. And we saw that kind of panic. But that doesn't really apply anymore as kind of the recessionary playbook. So what is the new recessionary playbook?
I don't think there is a straightforward recessionary playbook. I think a lot of the old rules seem to have been thrown out of the window. Things that used to track very closely, inversion of the yield curve, for example, just not working as they used to. Again, I think coming back to that point from Powell, right, it is about taking a look at the US economy, the data kind of in its totality. And at the moment, it's just not adding up to a kind of consistent, worrying, recessionary picture. I think, as I said, there is some slowing going on, some kind of normalization, and that's fine. I think that's broadly as I'd anticipate, but nothing overly concerning yet.
But I'm curious about the mismatch here that we're seeing in terms of we talked about it earlier with the small business survey that looks strong, the payrolls look strong, but then you look at some of these consumer confidence numbers, and that's where it feels like you see the volatility. What will it take for American consumers to actually feel the wealth that they're seeing in the data?
Yeah, and that's a good question. I mean, I think that even the consumer data, though, has been relatively mixed, right? We had that good retail sales number.
Yeah.
So even then, it's not quite a kind of neat overall kind of picture. I think sort of the political story might be interesting as well. I think when there's a bit more political certainty, you might see a bit of improvement in consumer confidence. And if we do get Fed rate cuts without a panicked message, right, importantly, that could help on the confidence side as well. But, the housing market's, of course, been very, very weak, and that's probably been an important part of that story too.
Let's talk about divergence. We're finally starting to see quite significant divergence amongst central bankers. So you've got the picture in the United States, kind of we're okay, we're on for a soft landing, things look like they're under control. Other central bankers are seeing different pictures. How big do you think that divergence could get? Like, how different does the picture in Europe and the United States look like right now? We're about to see the Riksbank potentially cutting by 25 basis points. We're going to talk to Swedbank's chief economist, who thinks that maybe they should be doing 50 basis points. How different is the data going to look over the next few months in different parts of the world? And are we going to get, therefore, a significant divergence in terms of the central bank policy reaction?
Yeah, that's a really interesting question. My central case is actually we don't see a huge amount of divergence between the major economies. Sort of sluggish, reasonable, positive growth rates for the second half of the year. But we're clearly going to see some differences, I think. But I think the big period of divergence is probably behind us. Remember that back end of last year when we had really strong US GDP growth, but we were actually sort of in recession in the UK, not far off that in the euro area. That was probably more divergence then, I think, than we might actually see in the second half of this year. Let's see.
That was in the data. We didn't get it in the central bank reaction, though.
Fair point, absolutely. But I think now from a central bank perspective, a lot of what's driving those central bank decisions is about inflation. And I think everywhere we're seeing a somewhat more reassuring inflation picture, and that's really what's going to drive these central banks over the second half of the year. And we're going to see probably more but gentle, cautious, gradual rate cutting from the US, from the UK, from the euro area going forward over the second half of the year.
But do the markets matter in that calculus?
They do, clearly. There's always a bit of a feedback loop, right? They're important. And if we see market panic, yes, that's going to affect the calculus somewhat. Where bond yields are, of course, matters to the monetary transmission mechanism. It matters to how effective interest rates are. It matters for in terms of the messaging is what you're going to expect from central banks.
So one of the arguments that we had, and I would argue still kind of exists, is that the markets are far more in control of interest rate policy than the Fed. And the reason I say this is because you have a record amount of funds right now in money markets. And when you look at the transmission mechanism into the real economy, drastic moves in the front end of the curve could hit the real economy faster than any changes in interest rates driven by the Federal Reserve. How much credibility does that argument have?
There's definitely a feedback loop, and I think especially in the US. Obviously, in some other economies, you expect the transmission mechanism from policy interest rates to be faster, quicker, more direct, depending, for example, on the structure of mortgage markets in different economies. In the US, I think that argument is stronger than perhaps it is elsewhere.
Final quick question. Cheap money has been taken off the table in the United States and in Europe. Interest rates have been raised. Japan has not, but Japan's about to. How big an effect, if Japan raises rates significantly, could that have in terms of the global economic impact?
It's a really interesting question, and I suspect it may come down more to the impact it has on markets.
Yeah, so that's the transmission.
I think so.
Melanie, great to see you. Thanks very much indeed for stopping by to see us. We really appreciate it. Melanie Baker, Senior Economist at Royal London Asset Management. Thank you very much indeed. Kriti, politics is the other factor we're going to have to throw into the mix as well, which we haven't... We saw the turbulence coming out of the French election.
Yeah.
Are we about to see something similar in Germany? What is going on with European politics, I think, is interesting. Ollie Crook's going to join us in a moment. We'll talk about that. I think he's also going to be talking about a big new chip plant, so investment in Europe as well.
I'm having a little bit of deja vu, because isn't this the exact conversation we've had with the Biden administration in terms of encouraging chip plants and this investment? It's something that's actually paying off in the politics, but also in some of the manufacturing sectors of Arizona, North Carolina, et cetera. I'm getting into the weeds, but of course we are going to dive into that. In addition to what's going on between Germany and Ukraine, we're going to go into that as Guy just mentioned, Chancellor Olaf Scholz heading to Germany's new $11 billion semiconductor project. More on that European chip story next. This is Bloomberg. We're about 30 minutes away from the start of the opening trade. European futures are a little bit mixed. Look, you had some green on the screen in the U.S. session yesterday. But you are seeing a little bit of a pullback, at least when you look at the FTSE 100. Marginal green on the screen when you look at the French and the broader European index as well. But again, does that kind of catch up? It looks like the sell-off is intensifying, though, right here in the U.K. But Guy, of course, this comes off of the green on the screen we saw in yesterday's session in the U.S. And I'm just looking at what actually drove a lot of those gains in the States. And it's the chip sector, but not necessarily because because that traditional tech trade that we like to keep on, because of a one very specific deal, AMD buying ZT Systems in an almost $5 billion deal. It's all about market share.
It's all about market share. Just to come back to the FTSE, I think that could be the oil trade. So we'll keep an eye on that. This is the Nvidia trade, isn't it? This is everybody trying to catch up with Nvidia, which is an incredibly vertically integrated company in its own right. It has the control of the software, it's got control of the hardware. It produces an entire package, a complete package that it can take to its clients. And that's what everybody else is now trying to replicate because they've realized the value of that. We haven't talked about it yet, but NVIDIA is also coming onto our radar screen in quite a big way. That's the big event. This week is Jackson Hole.
Next week's NVIDIA.
Next week is NVIDIA week. Yeah. And that's going to be the story. And that's what AMD and that's what everybody else is trying to do right now.
Well, I thought it was really fascinating because when the story first broke, it was literally 24 hours ago. It was pre-market. And you saw AMD as the only chip stock that was actually higher, which is strange because when you have an acquirer like that, the acquirer usually
But when
drops.
you're doing the right thing, when you're making a deal that works, then the market can recognize the value in it.
Absolutely. But then the market sold off on all the other chip names only for them to buy it later into the trade. So it was a really interesting dynamic. Nevertheless, the chip sector drove that story. And of course, we're keeping an eye on that as well, as we know that the chip sector has really outperformed given a lot of the grants coming from the Biden administration as well. So that's just one part of where the politics matches the chip sector as well. It's a similar dynamic over in Germany as well, where German Chancellor Olaf Scholz is visiting the site of a new $11 million semiconductor plant in eastern Germany. Now, the facility will be owned by 70% owned, I should say, by TSMC in partnership with several European chip makers. Let's get the details. Bloomberg's Oliver Crook joining us from Berlin all over that story. Ollie, walk us through the details of this project.
Yeah, so listen, they're breaking ground today in Dresden. Olaf Scholz will be there. So will the CEOs of all the other companies that are involved. So those are TSMC, Infineon, NXP, and Bosch. So just as a recap, 70% of this project will be owned by TSMC, but these other sort of European partners will each hold a 10% stake in it. And again, it's a 10 billion euro project. 5 billion of that, half of that is coming in a direct subsidy from the German government directly to this project in order to make it happen. And that is, of course, because the Germans are very keen on attracting this kind of industry to Germany. So a project today that breaks ground will not produce anything for another 3 years, so the end of 2027, but it will build chips that will feed the industrial sector as well as the automotive sector. For TSMC, it's really interesting because this is their first European plant that they have anywhere, and they've decided to do it here in Germany, and it's part of their slew of opening fabs all over the world. They opened one in Japan for the first time this year. They're spending $65 billion, as you were mentioning, Kriti, in Arizona on 3 fabs there. So really, really significant. And Ursula von der Leyen will be there today because the EU has stated they want to produce 20% of the world's chips by 2030. 2030 is not that far away. That seems almost impossible. But if they want to get at least a fraction of that, they need to get moving right now with projects like these.
Ollie, why Dresden? Why Germany? Did it just pay more?
Well, the answer to that, in short, is in part yes. So obviously, the Germans have been very keen to attract the semiconductor industry to Germany because, as we've talked about a lot on this show, Guy, the past sort of economic might of Germany is well established for several decades, dominating industries. The future is much less certain. They want to own the semiconductor space, so they're giving $5 billion to TSMC. They're giving $10 billion to Intel. So yeah, they're really ramping up the subsidies to attract this stuff. But why Dresden is because this is what they call Silicon Saxony. You have a number of very good universities here that do electrical engineering. You have Infineon already has a lot of fabs, and you need really specific things in order to cultivate the fab ecosystem. Things like, for example, very, very steady electricity supply, because if you don't have that, it fries the circuits and they're ruined. But more importantly, you need that labor force, and you need the people that can work in that. So as you build up more critical mass, Dresden is where the Germans want to do it, in Saxony more specifically. And, as of course, this also is to feed the auto sector, right? There are 600 chips that go into an internal combustion engine car. There are about 1,300 that go into an EV. So it's about securing, yes, the future of industry, but also the current industries within Germany.
And let's talk about kind of outside of the chip sector as well, some of the other stories coming on in Germany. Germany denying reports that it will cut military support for Ukraine. Ollie, this moved the markets yesterday. Walk us through where this leaves the budget.
Yeah, it had a major impact on the markets, but really it would have a much larger impact, I think, on the psyche of the war and a great many other things. So just to recap what happened here, we had the defense ministry in Germany that was requesting an additional 4 billion euros from the finance ministry for the budget next year. As we know, the German budget is very strained after that court ruling last year where they couldn't sort of do all these little things to circumvent the debt break. And basically the finance ministry said, no, we're not going to give any additional money to Ukraine. We will continue to fund what we've already agreed to, but we won't give any more. This, of course, sends a very, very poor signal to, Moscow, to a potential Trump administration who could very easily say, why should we be supporting Ukraine if the Germans aren't even doing it? Today, the finance ministry has walked it back. They said that they're still standing shoulder to shoulder with Ukraine, not very, very specific. We heard also from the chair of the Bundestag Foreign Relations Committee. This I thought was interesting. The debate about the future financing of military aid looks like a disguised withdrawal from Germany from responsibility. We cannot make our security dependent on budget constraints. So the question is, though, then how do you actually pay for this, right? Because this is not, the money is just not there. They want to talk, they want to point to the Russian assets, they want to point to the EU level funding, but as we know, fiscal space is very cramped. Could they do an emergency fund potentially to get around the budget? I suspect that they're going to have to make some space for this within the budget, but that'll be a negotiation over the coming weeks.
Yep. Ollie, to what extent has this got to do with the upcoming elections in East Germany in particular, where we're expecting the right to do very well? Is this part of that process, or is this divorced from that process?
Listen, I think it's very much a part of the process. A lot of the argument that you've heard from the far right, from the AfD, but by the way, Guy, we haven't talked a lot about this. There's a new party on the far left that is doing some very similar things in terms of, far left nationalism, far right nationalism, and both of them have said basically we are not really that interested in continuing to support Ukraine. And some of the arguments are actually sort of more tempered, which is while you're having such difficulty with the German economy and people are suffering so hard in Germany, why are we sending so much money abroad? And as you say, there are 3 elections that are happening in states around Germany in the coming weeks. We're expecting the AfD and the far left to sort of sweep into power here. So from a political perspective, the Schultz and his coalition need to be very, very careful about where they go about this, wanting to maintain sort of their mission statement to support Ukraine, while at the same time dealing with some of these concerns that could have really very real political consequences in terms of the power dynamic in Germany.
Let's stay with that political theme. Ollie, thank you very much indeed. Ollie Crook joining us out of Berlin. I want to factor in what's happening with oil prices. Oil prices dropping. This appears to be largely driven by a demand slump coming out of China. But it's also, we think, being driven by talk of a potential ceasefire between Israel and Hamas. The U.S. Secretary of State, Tony Blinkin, says the Israeli Prime Minister, Benjamin Netanyahu, has now accepted a deal. And Hamas now must agree, say yes, in his words. So he's going to Cairo, he's going to Doha to try and figure out exactly what the Hamas side wants in all of this. And we will continue to monitor his progress. As you can see, this appears to have had an impact on oil prices, which have taken another leg lower. Let's get a sense of kind of how the dynamics are working within the oil price. Anthony DiPaolo joins us now out of Dubai. Anthony, factor in the latest geopolitical news to the oil price. Is that what is driving this move lower that we're seeing on our screens?
Good morning, Guy. That news, which is a positive news that ceasefire talks are moving forward, is going to take some of the heat out of the oil price. It's going to take out some of that risk factor. It's been very difficult to attribute really any risk factor into oil over this last year, say, because the risks in the Middle East of a wider conflict are so high, but we just haven't seen those come into the prices. We've seen a few $5 or so swings up and down according to how things are going in the region. But again, this positive move towards a ceasefire in the talks is kind of taking the heat out there. Of course, we're not there yet. There still needs to be the side of Hamas accepting that. But this positive news that Netanyahu has said that the Israelis would accept some of those ceasefire stipulations, that's helpful in terms of moving those talks forward, Guy.
Well, Anthony, how much of we know that the geopolitics, of course, plays a very key role in what the oil price does. How much of this is also a function of China, a function of the oversupply out of the States? Or walk us through the dynamics from the other parts of the world.
Yeah, so the market is also looking forward. We've got those initial those immediate term kind of buffers that are moving the price up and back, and we've seen it quite choppy in the recent weeks. But the market is really looking forward to that weakness in China, where we're seeing some weaker demand there. Already, if we look at the exports, for example, just from Saudi Arabia, the biggest crude exporter, they've reached some of the lowest since the pandemic going into China there. So the exports into China are low. Of course, that does come during a summer period in the Gulf region, where it's very hot here. They're using a lot of oil domestically for crude burning here domestically. But we've also got low production because of the OPEC cut. So the market is looking at that market, whether it's weak, whether OPEC can put those barrels back in there. And they've also got in the back of the minds, the traders do, the fact that OPEC Plus, some of those countries that have made voluntary cuts of production, are set to start bringing some oil back later this year. Now, that's still up in the air. OPEC Plus could decide not to do that. Not to bring those barrels back, but that is still an overhang in the market, whether they're going to bring these barrels back and whether the market is going to be strong enough for them to do that, Kriti.
All right, we're going to keep an eye on that. Of course, Bloomberg's Anthony DiPaolo, we thank you so much for walking us through those dynamics. Of course, as we speak, we are seeing that geopolitical premium between Brent and WTI continue to narrow. On to another story that is, of course, top of the radar. The British tech entrepreneur Mike Lynch, among those still missing after a luxury yacht was struck by a tornado and sank off the coast of Sicily. Let's get more on the story with Bloomberg technology editor Olivia Solon, who's been, of course, monitoring the story. Olivia, walk us through what we know about what happened.
Right, so yeah, in the early hours of yesterday morning, a 56-metre sailing yacht called the Bayesian, which is owned by Mike Lynch and his wife, sank in a violent storm off the coast of Sicily. The boat was anchored and passengers were sleeping at the time. We don't know exactly how this storm led to the vessel sinking, but it did have this enormous mast. It's a sailing yacht rather than a motor yacht. And local fishermen did not go out. They didn't leave port that night because of the weather.
In terms of who was on board, what do we know other than Mike Lynch?
Right, there were 22 people on board, 12 guests and 10 crew. We've been told that it was a celebration of Mike Lynch's recent legal victory. So he was recently cleared of criminal charges of fraud in the US relating to his $11 billion sale of his software company Autonomy to HP. So it was Lynch, his family, friends and colleagues.
Talk us through the latest search and rescue efforts. What do we know there?
15 people have been rescued so far, including Lynch's wife, Angela Baccares, as well as a partner in his VC firm, Invoke Capital, and her 1-year-old daughter. 6 people are still missing, including Lynch and his 18-year-old daughter, Hannah, and 1 person has been confirmed dead. There are still specialist divers on the scene, and the UK's Marine Accident Investigation Branch, which sits under the Department for Transport, is sending 4 inspectors out to investigate.
We'll keep an eye on the story and look for any updates. Thank you very much, Olivia. Olivia Solon updating us on what is happening with this vessel going down off the coast of Sicily. We'll keep you up to date with that. We're going to keep you, of course, up to date with what is happening with the markets as we run towards the open. We are, 16 minutes away from the start of trading here in Europe this morning. Looks like a fairly mixed open at this point. Looks like the FTSE 100 could be under pressure, and we may think that that comes from the oil trade. So it looks like oil stocks could be a little softer this morning. Anyway, more on that to follow. This is Bloomberg. Good morning. 13 minutes to the start of equity trading here in Europe. The indications are that we're going to see a fairly mixed open. Positive for most markets. Looks like the FTSE 100 could come under a little bit of pressure. GSK looks like it could have a good morning, but I wonder whether the oil stocks are going to be under a little bit of pressure as well. You've got crude down fairly sharply, and that seems to be the narrative that is feeding through into that story. We're also still preparing for Jackson Hole. Friday feels like an awfully long way away, but we'll get there eventually. And Powell will give us his address, and we will hear from the BOJ. Joining us now, Rachel Evans, Bloomberg's managing editor for FX for the US and EMEA. Good morning. Is that what this week's still about? The data are okay. I saw the NFIB survey yesterday, painted a reasonably positive picture. Small businesses in the United States are actually seeing a fairly bright outcome at the moment. It feels like the totality of the data, and I keep kind of using Powell's phrase, looks all right at the moment. Should that guide us to what we're going to hear from Powell Friday?
I think it should. I mean, I think Powell has been very clear, like, throughout his tenure that he is going to be led by the data. He is data dependent. And every time he kind of, like, gets put on the spot about, you know, when is easing going to come, he refers back to the data and looking at inflation metrics, looking at the job market. I think the nuance that we might get a bit more of is which data, because there's obviously a very large suite of data that comes out from the US every month. And at the last meeting, he was very clear in guiding people to thinking about the jobs market and the labour market as something that they're really starting to watch a lot more closely now that it seems that inflation in the US is under control. So I think that's going to be where a lot of traders are kind of watching for exactly what sort of strength of language, warmth of language around the labour market in particular is going to be, because that's where we've seen kind of a few wobbles. Like the print sort of end of July was obviously very weak, and that is obviously what prompted this whole big sell-off and recalibration of how quickly the Fed was going to have to cut. Obviously, the data we've had in the last couple of weeks has been far more positive. It's painted a much rosier image of growth. So I think there's going to be an interesting question about how he sort of leads people through that balance between thinking about the jobs market, thinking about, you know, whether that is starting to tail off versus this quite, you know, as you say, you know, healthy-looking growth picture that we're seeing kind of elsewhere.
So what is the case for a cut then? Is it just normalization?
I think that's a part of it, yeah. I think, you know, there is that sort of sense that you need to kind of buy yourself some room in case inflation kind of picks up to be able to hike again. And there are, you know, sort of certain signs of some weakness, you know, lying below the surface. You know, obviously, some of that jobs data that we were just talking about is there. And I think there's just a little bit of a sense of kind of, you know, the time has come where we're in that sort of right kind of balanced part of interest rates. Maybe they're a little too high at the moment. There's no expectation that the Fed is going to cut to zero again, for example. I think we're seeing kind of 3%, 3.5% as being sort of roughly where they end up. But yeah, I sense that like now is the time to just sort of ease off a little bit.
Does the dollar bounce in this kind of an environment? The dollar's taken a hit for a while now. It's been tracking lower. I wonder whether better data could turn that around. FX is having a really big effect at the moment. It's been an absolute snooze fest for ages. And suddenly with the yen and what's happening with the dollar, it's actually kind of feeding through into asset prices in a big way.
Yeah, no, it really is. And I think, you know, obviously dollar-yen, a hugely important pair that we're watching at the moment. I think on the dollar side, you know, we have been seeing a bit of weakness in recent kind of weeks. I think that sort of reflects that sense that we are moving towards cuts, even if not super aggressive cuts. You know, so we are going to be seeing kind of theoretically an environment that weakens the dollar. But you have all these other cross currents, right? You know, dollar is never just dollar. It is dollar versus the yen, dollar versus the euro. So a lot of this is going to depend on that picture of divergence or convergence of monetary policy. Yeah. And we'll get a lot better sense of that at Jackson Hole. It's not just Powell who's going to be talking. We'll see Bailey, we'll see Lane, maybe even some of the guys from the Bank of Japan. So we'll see.
All right, okay. Bloomberg's Rachel Evans. We will leave it there. A lot going on, a lot of kind of hype being built up to the back part of the week. Of course, we're going to keep an eye on that. She talked a lot about Powell. We've got plenty to talk about in terms of, I think there's testimony coming out in Japan as well with Governor Ueda. Lots going on the macro front. Let's get a focus on the micro and get our stocks to watch with Joe Easton from our equities team. Joe.
Morning, Kriti. So we're keeping an eye on defence stocks once again today. Remember, this was one of the weak sectors yesterday on speculation that there could be a reduction in German spending on defence in Ukraine. Now, there has been some comments overnight pushing back on this, with a deputy government spokesman in Germany saying that they will continue to support Ukraine for as long as possible. But the other news, of course, is the speculation around a potential ceasefire moving forward in the Middle East. So that could actually be the biggest weight, given the decline we've seen in the oil price overnight. That does seem to be something the market is keeping an eye on. But bear in mind, we've already seen declines in these stocks today, so potentially we'll see a rebound or maybe even see those declines continue. Worth noting, of course, the massive gain in these stocks over the past few years, a 200% rise. This is an index from Goldman Sachs that tracks European defence stocks. We can see clearly a massive outperformer, but that sector in focus once again today. Another sector we're looking at is miners. We've got some earnings out from Antofagasta. This is the copper miner that has most of its operations out in South America. Now, they are reporting a jump in EBITDA of around 5%. Margins better than expected. The dividend higher than analysts predicted as well. And the net debt improving. We can see on the screen here, it has been a bit of an outperformer in terms of the last 1 year versus the Stocks Europe 600. But the mining sector, of course, has declined recently, given worries around the Chinese economy and around the production of steel that would be needed for the real estate market. So that has been a weak sector. And take a look how many sells on this stock. Antofagasta, 7 sells. Don't see as many sells on a stock as that very often. It is a negative outlook in terms of analysts, but potentially some positive lines from that one today. Then we're moving over into the French power space now. This is a mid-cap company called Voltalia. Now, overnight, Brazil announced that they are going to curtail renewable power generation in the country because they're worried about the grid being overloaded. So it is a bit of a niche impact, but Voltalia gets around 35% of its earnings from Brazil, and they've put out a statement saying that they reckon it will reduce their earnings by around 40 million euros because of this curtailment. And Morgan Stanley analysts today writing that they expect the stock to fall at the open of trading. Now, this stock has recently had a bit of a recovery from a decline last year, so only up around 2% on a year-to-date basis, but that one is called lower, as I mentioned, by Morgan Stanley. Keep an eye on Voltalia in the French mid-caps today.
Great stuff, Joe. Thanks very much indeed. Looks like all majors are going to be a little lower this morning. That probably on the back of what we're seeing with the oil price. Keep an eye on that. So that's going to be a factor that might weigh on the FTSE 100. At the other end of that spectrum, GSK looks like it potentially could have a good morning related to news we're getting on one of its key drug therapies that it's moving forward with. But certainly the oil majors, Kriti, look like they could be probably one of the biggest stories when the equity markets open.
Yeah, absolutely. You're already seeing that reflected in the futures picture as well. I'll also put another name out there. Darktrace, I think, is also actually shares potentially moving higher, even though, of course, we are monitoring the tragic situation with Mike Lynch at the moment. But the read-through from Palo Alto may actually be a potential positive for the stocks. We're going to see how that reacts at the open as well.
Wood Group also out with numbers this morning. Joe was mentioning Antofagasta, so looks like that stock will be a little softer. Wood Group looks like it's going to be a little firmer this morning. Broadly, though, it looks like most European futures are pointing to a fairly positive start this morning. We've seen a really decent rally over the last few days out of the United States. London looks like it's going to be a little bit of a laggard. We will get you the details. We will count you down to the opening trade. It is 5 minutes away now. We'll see you in a moment to update you in the run to that start of trading. This is Bloomberg. Tuesday the 20th, good morning. A couple of minutes to go until the start of equity trading this morning. Few areas you want to watch out for, but let's give you the context kind of out of the States into the session this morning. There isn't actually a lot to talk about here. Basically, we finished kind of where the US finished. There was a little bit of a rally after kind of where Europe closed yesterday, but it wasn't that significant. The significant thing here is that US equities continue to rally and we continue to push higher. The risk rally kind of rolling on. In terms of what that means for European futures this morning, not a great deal. We are pushing broadly higher on most of the main metrics. There is some exception here, and that is in the form of the FTSE 100, which is looking like it's going to be a little bit soft this morning. That could be the oil story being factored in. London heavy with that. But Euro Stoxx 50 futures up by 0.3%. S&P futures are kind of drifting sideways. We're waiting for Jackson Hole, but the data kind of coming through this week looks fairly positive at the moment. Anyway, FTSE futures at the moment down by 0.3%. So that little kind of move lower, actually I say little, decent move lower we've seen in oil prices actually could have an impact this morning in terms of the stock story that we're watching here, Kriti.
Yeah, on a micro basis, I think it's going to be a little bit of a revamp trade, at least when it comes to defense. If we do start to see some of the sell-off get pared back from yesterday's trade, we of course know that was a big hit coming off the Ukraine budget aid story coming out of Germany. So that is a sector we're keeping an eye on. We're also keeping an eye on cybersecurity stocks. Palo Alto coming out in yesterday's session, picking up some of the business that was lost by CrowdStrike out of that after the outage earlier this month. So we are going to see if Palo Alto's gains actually feed into the likes of Darktrace as well. And then of course we have our eye on Antofagasta, which I have to say is a really fun name to say, but their profit falling in line with market expectations. We'll see how that trades, Guy, at the European market open.
Keep it on the commodities. It's going to be a big theme, I suspect, running through the markets this morning. Right, here we go. It is time for the opening trade here in Europe this Tuesday, the 20th. We are expecting London to be a little bit of a laggard today. The reason for that, as we mentioned, keep an eye on the commodities as to what is happening elsewhere. I think it's going to be more of a mixed picture. Keep an eye maybe on some of the pharmaceutical stocks as well. GSK looks like it could be of interest. Looks like Airbus could be in the running for a decent order coming out of Saudi. That could be a factor that we're watching out for as well. But the FTSE, a little bit of softness creeping in at the moment. It's not much. These markets are kind of drifting at the moment. It's mid-August. We're waiting to see exactly what Powell says Friday. then I think things kind of amp up. Friday into next week, we're going to be talking about NVIDIA. This could be the kind of the low, the mid-August low that we're seeing right now. But there you go. A little bit of weakness into the FTSE 100. Kriti, we're down by 0.2%. My question is, why?
Well, I think your suspicions were accurate, Guy, when it comes to some of those initial moves. The oil was really the suspect here, especially from the stock 600 as well as the FTSE. You're seeing likes of Shell, BP, even Rio Tinto. The commodity space broadly seems to be what's dragging down this market, at least in early trade. What's lifting it is the tech sector. And I'm curious about how much of that is a read-through from what we saw in yesterday's session. ASML, SAP are your biggest index contributors to the upside. But you're also seeing plenty of the other kind of heavyweights as well. LVMH, for example, is one of your big movers to the upside as well. So that's going to be an interesting one. We are still waiting for some of the German defense manufacturers to trade. So we'll see if there's a little bit of a buy-the-dip mentality, Guy, when it comes to those names.
Yeah, as you say, oil is down. I think we probably saw that one coming. Down by okay amounts, actually. IBP's down by 1.25%. Yeah. Shell's down kind of circa 1%. But this risk rally that we've seen over the last few days, the market is basically sort of, if you want to get involved, if you want to get back in, it's kind of an index weight story. So you have to go in and buy some of the bigger names that are out there at the moment. So ASML does well. One of Europe's biggest cap stories. You've got Inditex doing well. You've got some of the tech names, as you say. Airbus is tracking a little bit higher this morning as well. These are the weights I'm talking about here. But luxury is been tracking higher for the last few days. So it's interesting to see that stock story continuing. But this is part of this kind of broader risk rally that we're seeing. But there you go. ASML, Safran picking up a little bit of ground. Hermes doing well. Mercedes picking up as well. These are the kind of names you would expect if the risk rally is going to be kind of continuing here in Europe. It's been a strong performance over the last few days, really strong performance over the last few days. Feels like the beginning of August is a distant memory for equities.
It absolutely is. And I should mention some of the two other stocks we were keeping an eye on before the market opened. Antofagasta, which, of course, their profit came in a little bit lighter than expected, or at least met market expectations, I think is a better way to phrase it, but a little bit lighter. They're given the expectations were a bit higher. Shares higher by about 0.4%. Dark Trace is the other one we're keeping an eye on, given kind of the fallout with Mike Lynch as well. We're monitoring those developments, but also just given the read-through going into from Palo Alto. Those shares relatively flat right now. We're not seeing a ton of volume there, but we will keep you apprised as we get some of those initial market news. That's your micro. Let's go back to the macro here, because green on the screen seems to be the theme of the day on both sides of the Atlantic. Let's get a little bit more insight here. Emer Walsh, head of investments for Europe over at Mercer, joins us around the table. Emer, look, not a lot of people are at their desks right now. Light volume, light liquidity. How much of this flips, this green on screen flips, when we see September and we see more volume hit this market?
So I think overall, from a global perspective, we're quite positive on the economic outlook, which is going to have a knock-on impact on equities and be positive. Overall, we're 3% overweight to equities. It will vary by region, so we different views in developed markets versus emerging markets and Japan, more positive on Japan and emerging markets than developed. But I think, you use the word normalization earlier, and that's what we're seeing. Softening in the US, very much soft landing is expected from our perspective. But then from the economies that haven't done as well, so the UK, the Eurozone, a modest recovery in those, which again will kind of drive stock performance over the short term. So
this was a conversation that Guy and I have been having all morning. What is the tailwind for equities here? Is it the prospect of rate cuts, or is it the economic data itself?
So I think there's two big risks in the system at the moment. The first is that risk of recession. We saw the reaction. I don't know, are we calling it an overreaction at this stage?
Feels like an overreaction now. The market's bounced back.
Exactly. It's
what are you calling it?
It's a disament. We think it was an overreaction. We do think the market is pricing in too many Fed cuts for the end of the year. So we're estimating 3. The market is at 4. But, we'll obviously get a good indication, hopefully, from Powell on the direction of travel and the speed. But, I think the kind of overreaction, as we call it, it's the recessionary fear. That's kind of one of the main risks.
But if we get 3, is that a good thing? Because it's a good thing because the data are okay. So
Yeah,
as
yeah.
a result of which, the economy is looking okay, so we don't need to
exactly.
chuck the risk assets out of the window.
Yeah, so equities should perform pretty well in that kind of 3 rate cut scenario. It's more kind of on the bond side. If you get more aggressive cuts, bonds are going to rally, but more kind of hawkish, and they will pare back. So we're underweight bonds at the moment. But I think that recessionary fear is the big thing to watch, and then also the geopolitical risk. So Russia, Ukraine, what happens there, the impact on Europe, energy prices, etc.
Just sticking with the bonds for a moment. Bonds did do their job, though, didn't they? When we saw this turbulence at the beginning of the month, we actually saw balanced portfolios delivering some balance. Isn't that a reason to want to own bonds at the moment, given the risk maybe you've laid out?
Yeah, exactly. And, the correlation is kind of normalized again, back to the normalization point. So, kind of more balanced portfolio, diversified. You don't want to go all in, concentrated in US equities, for example. We're very much a believer in investing broadly. So that definitely includes a component in bonds, although we are underweight at a global perspective.
So, in order to have outperformed since the beginning of the year, you have had to have been long US tech. You've had to be long US stocks and you had to be long US tech. That trade is over. So if I can match the market, I can outperform the market without owning tech.
Yeah. So there's actually a really interesting dynamic, I think, going on in active global equities at the moment, not just global, but also regional. And a lot of portfolio managers are underperforming the benchmark, and that's because this index is so concentrated at the moment. So by that, I mean, let's say in the S&P, the top 10 stocks, it's over 30%. So to outperform in that environment is very, very challenging. So, for example, if you feel Apple is overvalued.
But are we going back to where those kind of more balanced portfolios do better? Is that the story for the rest of the year?
Yeah, a more normalized environment is what we're anticipating.
Let's go back to that concentration story, because there's been this, we're talking a little bit about diversification, et cetera, but the client pressure that I think we've spoken to a lot of guests on the show about in terms of getting in on that yield has it feels like that would only build in line with the recent correction that we saw, a 10% correction as well. You compare that to what you're seeing in the bond market, there seems to be this honestly building correlation as well between the safety of the bond market and the safety of tech. And I'm curious, going into the back half of this year, especially in the face of a U.S. election, is that not all the more reason to pile into U.S. assets?
From our perspective, no. We do think valuations on the equity side are quite toppy in the US, so we don't have a direct overweight position in
even
US
after
equities.
The correction.
Yeah, exactly. Some would have taken it as a buying opportunity, that dip. If you have the right governance, you can facilitate that. But we actually took that correction as a way to go underweight to bonds. So, we very much, as I said, invest broadly, so not that concentration in US tech, but, not going underweight. Going underweight against NVIDIA, they've returned 150% year to date. That would, if you were underweight, you would have a huge detractor from your portfolio.
So give us a range here on the bond picture. How low can yields go?
On the 10-year, like 3.6.
By year end?
Yeah.
US 10-year.
Yeah. So, kind of 3.6 to 4 is a plausible range. As I said, we are underweight to bonds, but we'll be very much watching the data so closely, because you get a couple of bad labor markets, it could change very quickly, and I think that recession risk has increased relative to a couple of weeks back.
If the ECB cuts rates, is that a reason to want to own Europe? Equities.
Yeah, Europe is an interesting one. It's very much a mixed bag at the moment. It feels like it has been teetering on recession for quite a while now. Obviously, services, there's bright spots with services, the periphery. Also, there's a lot of pent-up savings, so they're being spent at the moment, which is what we're seeing coming through in the data. But obviously, manufacturing is the key concern. German manufacturing, what's going to happen with that? But inflation is coming under control, and we think the ECB, has 3 cuts in it before year end.
And what is that? So, ECB cuts by 3. Is that enough of a reason to want to own Europe? Is that going to? What kind of an effect is that going to have right now? Given the kind of it's a really murky picture right now. We don't know what's happening in China. Europe is an open economy. We can't figure out. It feels much more difficult to figure out what the economic trajectory is in Europe.
Yeah, exactly. And we don't have an explicit overweight to Europe at the moment for that reason. So, you know, Russia, Ukraine, since that scenario unfolded a couple of years back, there has been a bit of nervous sentiment against Europe, you know, and I think it's just the impact on oil prices, etc., and how that will affect Europe. So I think it's see how the situation unfolds. You know, hopefully we can kind of get productivity going and paint a
sounds great.
Here's hoping. But walk us through that ripple effect though on the oil picture. I mean, it feels like. You know, 3 years ago, when you saw a drop in oil prices, it immediately created this boost in equities because of the sensitivity to inflation. The same argument could be made with even chips as well, given that inflationary picture, and that it was used as a vehicle to kind of hedge that. Is that mechanism still relevant? If we start to see a drop in oil prices, for example, is that reflected as a transmission mechanism as a tailwind into other risk assets still there?
I think it's there to an extent, but probably to a lesser degree than previously. And that's largely, if you think of Germany, their natural gas reserves, the supply is at a 5-year high, so less reliant on oil prices. So I think that probably, you know, could transpire, but maybe less so than previously.
Emma, we'll leave it there. Nice to see you this morning.
Yeah, lovely to see you. Thanks.
Emma Walsh, Head of Investments for Europe at Mercer. This is what the Core 6 looked like this morning. This is some of the biggest trades around Europe. In terms of what we're seeing, broadly, it's the oil price that is under pressure. It's interesting that Nestle is seeing a little bit of weakness today, but broadly, we are seeing technology coming back. We are seeing luxury coming back. The FTSE 100 is under pressure. You've got oil stocks lower this morning. You've also got BT Group under quite a lot of pressure. Let's find out why. I think it's got something to do with Sky, but let's get the details with Joe.
It's exactly that, Guy. It is related to Sky. Now, some potential competition worries for BT this morning. There's a story in the Telegraph saying that Sky will potentially start to be using one of BT's rivals for its fibre network, for its broadband, potentially using City Fibre instead of BT's Openreach network. Currently hosts around 5 million Sky customers, according to the report, so they would be switching over to a rival. And as such, we are seeing a big drop in BT at the open, one that we hadn't had on the radar today, but it's down 5%, one of the biggest weights on the FTSE 100, alongside those declines in the oil price. But that does seem to be the reason, this report in the Telegraph around the Sky network potentially switching over to that rival. Then we'll check in on some aerospace and defence stocks. A few things going on here. Of course, the reports around the German government pushing back on those reports yesterday that they would cut back on defence spending in Ukraine. That does seem to be having a bit of a positive impact on the likes of Saab, though Rheinmetall actually slipping a little bit lower now. We're seeing some gains in Senior and Rolls-Royce. There was that news overnight of Boeing potentially halting production on one of its newer aircrafts due to some issues with an engine mount. Bear in mind, Senior, Rolls-Royce both supply to Boeing, so that is another thing to keep on the radar. But these stocks pretty much positive at the moment. Then we'll take a look at some earnings, down to some of the last of them at the moment. Anto actually slipping some positive numbers in terms of the margins and dividend, but actually the earnings, as Kriti mentioned earlier, missing expectations. We've got John Wood, the takeover collapsed a few weeks ago. That's the engineer in the UK, the oil engineer, coming down a bit on their weaker earnings. Coloplast in medical tech, and Salmar, believe it or not, is a salmon company, downgrading their guidance. We're not eating enough salmon, according to them, and they are cutting their forecast today. That one's down 3% over in Norway. Then we'll check in on Voltalia. Now, this is the power company we flagged in StockSwatch, down almost 14% today. Brazil cutting back on some of its renewable power, trying to curtail it. They've got too much renewable energy on the grid, and they think that could lead to a potential blackout. So they are putting some curtailments on the grid. Voltalia hit hard, one of their biggest markets. And finally, in the pharmaceutical space, got one morning call now. JP Morgan downgrading Genmab over in Denmark. They've had a buy rating, overweight rating for 4 years, finally calling an end to that trade. It hasn't quite worked out as well as they would have expected. And Genmab falling 1.5% in Copenhagen this morning.
All right. Joe Easton, I'll take it. Don't worry, guys. I got it. Joe Easton from our equities team, we thank you so much. Coming up, we're going to go right back to the macro here. To cut or not to cut, we're going to discuss the state of the Swedish economy ahead of the morning's rate decision from the Riksbank. That conversation next. Stick with us. This is Bloomberg.
Welcome back. You're watching the opening trade. We are 18 minutes in. I'm just trying to work out what the points drops for the FTSE 100 look like. Oil is down. We'll come on to that in just a moment. That's kind of a big chunk of it. But the biggest chunk of it at the moment, 10 points for the FTSE 100, is BT. This is the telecom group. We've obviously been talking about the recent ownership change. But this morning we've got this story that is coming out of the Telegraph newspaper suggesting that Sky has struck a deal with one of BT's biggest rivals, City Fibre. Obviously, this is a blow in terms of the kind of the backbone network story for BT, and BT will Sky, which has got around 5.7 million broadband customers on its, which is on BT's network at the moment, might switch. So this is why BT is taking such a big hit this morning, and that's translating into the FTSE 100. I'm glad I got there. We got there eventually.
Well done. Well, right next to BT, you've got plenty of the oil majors as well, also weighing on the entire index. Shell is your biggest index contributor to the downside, though, and I think that's pretty significant given the oil price move that you're seeing. Yep. BP is right alongside there, but I also have to mention we've seen some of the other commodity names as well take a little bit of a hit. So Equinor is one, Rio Tinto is another, and I think that's pretty interesting given that really it feels like a concentration on the oil move, but spreading into the broader commodity space.
I need to correct myself. BT is 1.76 points for the FTSE 100. Shell, I think I may have got BP and BT mixed up, is 1.76, but it's still a big chunky amount. But it's basically the commodity trade, as you say. BP and Shell are adding to the downside.
One of the top five contributors to the downside.
We'll get it straight eventually. Instant corrections. Let's talk about what is happening with the Riksbank. It's set to announce its latest rate decision around 15 minutes' time. Analysts expecting 25 bips, 25 basis point cut. Though some, I have to say, are talking about the need maybe for a 50 basis point cut. Nordic economy and government reporter Oits Umelas joins us now from Oslo. So what are we expecting? Is 25 basis points baked in? Is that just a continuation of what we've seen thus far? How big a risk is there that we see more coming through from the Riksbank?
Yes, indeed, all the economists are expecting a 25 basis point cut, but domestically there's been a growing pressure lately for a half-point cut, and that's mainly because the economic data that we've been getting lately is on the weak side with very few exceptions. So we've had manufacturing activity going into contractionary territory. We've had second quarter GDP flash estimates indicating that there possibly was a contraction in the second quarter. Unemployment is growing up, and on the consumption side, the data is also pretty weak. So all in all, those hopes for recovery just don't seem to be materializing yet. And considering that inflation has been below the Riksbank target now for 2 months already, that basically shows why the pressure is for an even bigger cut.
Well, wait, it also feels like in the June meeting, there was a split in the consensus between whether we get 2 or 3 cuts. Moving forward, what tips the scale, do you think?
So, yes, the Riksbank said in June that they will most likely make 2 to 3 further quarter-point cuts this year. But they said that was on condition that inflation prospects remain the same. And with inflation below the Riksbank forecast and below its target, that's making some people change their mind. And the market is now expecting 3 more cuts on top of today's reduction.
Let's just talk about the transmission and how quickly it happens. The Swedish economy has reacted relatively quickly, and we have seen the effect of tighter monetary policy coming through. Do we get the symmetrical effect on the other side? If we get rate cuts, and a lot of them, how quickly does that translate, given what happens with the mortgage market, what is happening in housing more broadly? How quickly does that affect the real economy?
Well, indeed, because of the high share of the variable mortgages, Sweden arguably has one of the fastest transmissions to the consumers. We don't really have quantifiable data on that, but some analysts have been arguing that that is the reason that basically allows Sweden to have actually lower rates than the ECB, and that would basically allow them to avoid issues with the krona weakness.
Well, speaking of that krona weakness, though, we're also seeing a fairly dovish Federal Reserve lately and a fairly dovish ECB as well. Talk us through the dynamics that the BRICS Bank is then facing when it comes to pressure from these other two central banks, but also the euro and the dollar as well.
So the Riksbank has been aware that it can't stray too far from the ECB in terms of rate differential, as that would basically add to krona weakness and possibly then fuel important inflation. And the Riksbank has been well aware of that for the last couple of years. So that definitely is a factor that they will be watching going ahead.
All right, Bloomberg's Nordic Economy and Government Editor Oyt Omolas, we thank you so much walking us through kind of the dynamics that we're seeing ahead of that crucial Riksbank decision. And Guy, again, a 25 basis point cut priced into the market right now. We've got a guest coming up, though, that's saying maybe 50 needs to be on the table.
That's the domestic story at the moment. Everybody's looking at the data coming out. They're looking at what is happening. They're looking at the rapid slowdown that we're seeing in the economy. And certainly the more recent data point to maybe a need for a more aggressive cut. So it cuts. If we get 25 bips, is the message we can do much more if we need to, i.e. is it a dovish 25, or you get the 50 and everybody's a little bit surprised. You are seeing some euro weakness this morning versus the Swedish krona. We'll keep an eye on the Noki Stocky as well, but euro SEK is certainly on the move this morning, and it looks maybe as if the market is maybe pricing in that 25. Maybe there has been some anticipation that we do get 50, and that's being priced out a little bit.
Yeah, well, I think the question you asked at the end about the kind of read-through into the real estate market is the crucial one, because when we had that big panic, I want to say, when was that, last year? You did start to see that kind of form as a roadmap for what could happen if you start to see cracks in the real estate market in other parts of the world as well. And suddenly the Riksbank became kind of this roadmap for even the Federal Reserve, which I think is a very interesting dynamic, especially when Sweden is operating at an inflation rate less than target. How many central banks can say that right now?
Absolutely. And the discussion point at Jackson Hole is about making monetary policy more effective.
Yeah.
And one of the reasons why it hasn't been is because there's been issues in the housing market in the United States. You think about the fact that a lot of people locked in very low-rate mortgages. That has gummed up the housing market, but what it has meant is you don't get the rapid transmission that you would normally get when you see rate hikes coming through. So the economy's been able to run a little hotter because of that effect. Sweden's the exact opposite. It's seen the kind of very tight monetary policy. The effect has been very fast because of that transmission through the housing market. But maybe the kind of the symmetrical side of that is you get rate cuts, and actually you do start to see the effect of that. So different central banks seem to be on slightly different paths in terms of how transmission works, and I think that's going to be a really interesting talking point coming out of Jackson Hole.
It is, but I think the currency piece as well is so significant, and I think you mentioned the euro weakness this morning as well. The fact that you're seeing a 25 basis point cut priced in, you're seeing very low volatility, by the way, in the Swedish krona, which is standing out from every other central bank decision they make. Is this just a function of it being an August summer trading day, or is this actually something that is pretty well telegraphed?
We have seen surprises. Central banks have delivered a few of the kind of, let's call them peripheral, that would be the wrong description, but certain European central banks have caused some surprises. Anyway, we're going to be talking about this a little bit more. We're going to get that decision very, very shortly. We'll also get the reaction of the chief economist of Swedbank. He's calling for maybe the need for 50. But certainly what we're seeing this morning is euro-Swedish krona. We're seeing some euro weakness in that pair. We'll get the details of the Riksbank decision next. This is Bloomberg. A 25 basis points cut delivered by the Riksbank. That is the breaking news that we have on the screens right now. The rate goes from 3.75 to 3.50. As anticipated by most people, we do get that move, and you've been seeing that priced in over the last couple of minutes into the pairs, euro-Swedish krona. As you can see, we've been seeing some Swedish krona strength. I just wait and see whether we get some commentary from the Riksbank. Riksbank rate can be cut two or three 3 more times this year. So the Riksbank is saying that policy rate cuts can be somewhat faster. So this is the dovish cut that we were talking about. You get the 25 bips, you get kind of a cautious cut, but then you get the dovish commentary that goes with it.
And continue to see strength into the krona, even off the back of the decision. So priced in to some extent, but you are still continuing to see people buy into that currency. I think this is really fascinating, given that we just had this conversation with a reporter out of Oslo as well, walking us through the dynamics here. This is one of the only countries in the world that actually has an inflation rate running below target. So this is really where the case for cuts are far more crucial as well. Let's bring in a true expert here. Matthias Persson, Swedbank's chief economist and global head of macro research, joins us this morning. Matthias, you came in expecting, or at least calling for, a 50 basis point cut initially. They're coming out with 25. Walk us through your take and your initial reaction of what we're seeing.
No, I think this was highly expected. So our call was a 50 basis points cut. However, I think given where the Swedish economy is, you know, we are interest rate sensitive economy. We have really felt the Swedish economy, the hikes that the Riksbank have done. And this is very restricted territory we are. So it was a very expected cut today. Unfortunately, not 50 basis points, which I think the real economy really needs.
Is the case now, therefore, for an accelerated path lower? The statement comes out, says policy can be cut 2 or 3 more times this year. This can be done at a faster rate. Is that what you would now expect to see, Matthias?
Yes, absolutely. I think this was you know, if it wasn't 50, this was the best outcome. They are a bit more dovish, and they are clearly seeing that the Swedish economy needs more cuts. And as I did this morning, I think is very good. We might actually have a cut already in September, so in a month's time. And the difference between a 50 basis points cut today and an additional one of 25 in September is very, very small. So I think this was very, very good.
So, Matthias, walk us through some of the dynamics that we are seeing within the Swedish economy as well. I want to get to kind of the transmission mechanism the guy was talking about earlier in the show as well when it comes to real estate. But first, can we talk about unemployment for a second? Walk us through the issues in the labor market in the Swedish economy for a global audience that may not be necessarily monitoring that tick by tick.
No, so during the summer, the unemployment in the labor market showed some resilience, and actually was quite stronger than we expected. But domestic economy has really been hit by the rate cuts that we have seen in order to bring down inflation. So what has helped and kept growth a bit higher than it would have been otherwise is export. Export has performed very, very well. Also investment, but the domestic demand is very, very low. You know, variable interest rate is the most popular rate to have today, roughly 60%. All new mortgages that are taken out and have been taken out this year has been variable rate. So we have really felt this. And that means that consumption, retail sale, everything has been weak. Construction, for example, of housing and housing investments are very, very low. We have seen a fall, really a very clear fall in housing construction. That will not start. That will not start this year. Maybe a bit next year. So the domestic economy has been really hit by higher interest rate. I think that's good because we understand how monetary policy works, and then the Riksbank needs to step up and increase the pace, as they clearly have said today, with more rate cuts coming in the near future.
And Matthias, I believe the second quarter output, has actually, the preliminary readings of that aren't looking that strong either. What is the issue there? Like, is there a certain sector that is coming under particular weakness, or is this something that you're seeing just broadly across the economy? Where historically can we find those parallels?
I think the weakness in particular in the Swedish economy is everything related to household consumption. So retail sale, consumption, very, very low. Very weak. We haven't seen any pickup in that at all, and we wouldn't really expect it. We had a first rate cut in June, and from that we would expect a slight increase. So really, retail, construction, we could see today that some of the construction firms are seeing the weakness continuing going forward, and are planning to lay off more employees going forward. So our forecast is really that we think unemployment will continue to increase during the autumn, winter, and we need more rate cuts. So it's really, everything related to households in the Swedish economy that feels the higher interest rate that have pushed down Swedish economy. So particular retail, I would say. Retail sales is very low.
Matthias, how quickly does a rate cut in Sweden transmit to the economy?
When I say fast, that's because we have variable rates. So most are linked to 3-month interest rates. And it takes probably 3 months to 6 months to have a full effect of the rate cut we see today. And that is much faster compared to many other countries, for example, the Eurozone or the US for that matter. So it will transform, but it takes time. And that's why I have 50 basis cuts today, because households can see that things will improve in a year's time, but we are not there yet. And then the central bank and the Riksbank needs to push rates down. And we are, today after the cut, we are at 50. We estimate that the neutral rate is somewhere close to 2%. So there is still quite far to go for the central bank to actually reach neutral level.
OK, so in terms of how long we stay at that neutral level, once we get down, are we back into a hiking cycle? Given the speed of transmission, how easy is it going to manage those last kind of phases? Are we going to see more volatility? When do you think the first hike comes through from the Riksbank?
That's very good. I actually, in our current forecast, we don't have any cuts. And we are just updating our forecast for 26 as well. But I think cuts can very well come. But I think for now, it's really cuts that are needed. When I look at the Swedish economy, in our latest forecast and how I think about it going forward, this is the first time for a very, very long time where we will have monetary policy easing. And we also expect fiscal policy to be a bit more expansionary because we have, as you know, we have a very low debt to GDP in Sweden, just above 30%. And we know that the Ministry of Finance wants to be a bit more expansionary in the budget for next year and probably also for 2026. So I'm super optimistic. Of course, we don't know exactly what will come out of both the rate cuts and also fiscal policy, but I'm optimistic about the Swedish economy growing above potential for 2025, and I would expect 2026 also to be very strong for the Swedish economy.
All right, certainly something we're going to be keeping an eye on. And Matthias, of course, as we speak, we're starting to see weakness actually show up in the Swedish krona, perhaps pricing in what that future trajectory looks like. Matthias Persson, Swedbank Chief Economist and Global Head of Swedbank's Macro Research. We thank you so much. Folks, stick with us. We're going to keep you apprised of all these market moves and get back to the macro story in just a few moments. This is Bloomberg. Welcome back to the opening trade. About 42 minutes into today's session, you're starting to see a little bit of green on the screen when you look at the stock 600, higher by about 0.2%. Some outperformance as well in the German index. It looks like perhaps a little bit of buying back on some of those defense names, but underperformance right here in the UK. A lot of that's coming from the oil story and, of course, BT Group, which are taking a good chunk of the losses as well. But this all follows some green on the screen that we saw over in the States yesterday. Perhaps a little bit of some of the betting that the Fed is going to signal it's ready to start cutting rates. A little bit of a ramp up going into what we're seeing on Friday in Jackson Hole. Let's get the thoughts. Virginie Mason, who joins us around the table, Global CIO of Equity over at Allianz. Thank you for joining. Thank you for coming up.
Thank you.
It looks like a light volume, light liquidity kind of environment. Everyone's waiting for the macro. The debate around this table this morning has been, do rate cuts help the tail? Is that a tailwind for the stock market, or is actual economic data what's driving the stock market? What do you think?
Well, I think it's about the glide path. So it's the data in addition to the earnings power, which is linked to the growth, right?
Yep.
So is the growth really a soft landing, which it looks like it is? Which companies are going to do well? But all this said, a fair amount is priced in. If you look at markets up 23%, where are the opportunities? Perhaps one of them is if we have, in fact, a slightly softer dollar is in emerging markets because they've performed on a 12-month basis about half of that, right? So you have to look for those nuggets of growth that you can position in, but still have a very careful portfolio construction because we'll have bouts of volatility. It's around the election.
Do those bouts of volatility come more frequently? Because we haven't had one for ages, and then we get a big one.
Yes.
Is that something that I should get more used to?
I think over the next few months, until the U.S. election is in the, down, until the French resolutions happen, until, you have those bouts of political-linked volatility where the markets, we have very little control, right? We can observe, we can analyze the tendencies, but in the end, there's an element of loss of control, so you have to plan through diversification.
When we talk about the diversification, though, I mean, we've been hearing this. I feel like that's been the narrative for the last couple of years as well, and yet there's so much client pressure to say, well, look, NVIDIA rose 1,000,000% or whatever it rose in one day. Why are we not in on that? And that seems to be what's creating this kind of almost short squeeze and this momentum-driven trade. Does that just go away?
I think it will take a bit of time because, of course, you have the indexing or the ETF factor there, right? When you have such a concentration in U.S. tech in the U.S. market, the unraveling, even if you had lower performance, would take a long time. I think, however, if you look at, I know for some of our quant strategies, where you control your tracking error and you're very mindful about positioning on an acqui basis, there's still a lot of added value that you can have for portfolios. U.S. only, U.S. equity only is more difficult for sure.
If I am underweight tech, am I going to underperform the market over the remaining part of this year and into next year?
What is tech?
Okay. If I'm underweight the Magnificent Seven, am I going to underperform?
I'm asking. I'm being a bit cheeky here because I think we
welcome that on the show.
Thank you. We like software. We like the second wave. We like the enablers. We like the next wave of productivity enhancement. In terms of the Max 7, it's not one group of Max 7. You have quite a few companies in that group. You want to own some of them. But the benchmark weight, again, if you run a U.S. fund only versus a global fund, is going to be... So you want to have exposure, but you also want to be in the lower valuation second wave of enablers because this is where the big, I think, next wave is coming.
But doesn't it create almost a vulnerability to this massive CapEx spend that whereas an Amazon or an Apple or a Microsoft can write that check and not think twice about it because they're sitting on these massive cash reserves, that second wave has a far more upfront cost with a far longer kind of return on capital. Why is that not a bigger concern?
Yes, that's absolutely right. And I think this is why it's taken some time, right? We've been in the plumbing phase, and you're right, the billions of capex from the large companies, that can happen. And this is why this is the second phase, because companies that are smaller will need to see really what the benefits are in order to spend the money. But we are starting to see that through applications, right? Although, to be honest, it's been a little bit harder, one would say, and it's taken a little bit longer, but I think this is what's coming. But carefully, because some companies are going to benefit and some won't.
Well, it also, we both want to get in on this conversation, but it also feels like the only reason that there is so much of this kind of appetite to even do it is because the economy is expanding at the moment. And this is you're seeing a lot of resilience. There's a lot of still extra cash in the system, whether you're talking about consumers or businesses as well. What happens if that recession does hit? What happens if we get a new administration in 6 months' time? To me, I feel like we have so much excitement about this sector and the second wave, and yet the risks are piling up, and no one seems to be hedging even against it.
So I think this is why you want diversification. This is why you want to also look, and I was saying, in the past few months, we have rebalanced some of the portfolios towards a more defensive tilt. Now, clearly, growth versus value versus quant, very different portfolios. Because you will have that as a risk. Now, clearly, I wrote something recently, summer storms, political winds, right, coming up. This is why, depending on which candidate will win, you'll have more of an inflationary element, less of an inflationary element, etc. Your differences, that will have an impact on future rate positioning.
But so far this year, diversification has equaled underperformance. Does that change given some of the tensions that you're talking about?
I think, well, in our case, diversification for some of our strategies, again, I'm talking ACRE, not US only, has actually worked very nicely. Okay. So looking forward and facing the between now and November election in particular, I think you have to maintain quite a balance while keeping your appetite for long-term trends, which is what that technology, digital Darwinism, transformation is going. But you have to be very mindful of air pockets and pick stocks. Trade a little bit, even if you're a long-term investor. If you have those bouts of over-enthusiasm, trade a little bit. If you have pessimism like we had, a couple of weeks ago, trade a little bit. And look at it on a global basis.
For the last few years, currency has not mattered to most equity portfolios. That feels like it's changing now in quite a big way.
Yes.
How do I think about that now? Because a lot of people haven't been doing it, and I'm wondering how you do it properly.
So this is true. So for us, as bottom-up investors, it's mostly bottom-up and through earnings, etc. But I do agree that if you think between now and year-end, clearly you have the yen, right, part of the equation, and the dollar. Softer dollar could be very good for emerging markets in general, and then you have to be, right? For the yen, or Japanese team is still very enthusiastic about parts of the market, but you have to be very mindful. The key question then is what happens to the euro. The situation in Europe is a little bit, inflation is a little bit more sticky and growth a little bit slower. So again, we go back to the, we go back to the glide path and what happens in that, because in that environment of growth more slow, you looked at the German numbers recently, etc., you'd want more rate cuts. At the same time, we have to see what service inflation is doing. So I think yen, euro, dollar, we're going to have some movements there, which actually is not a bad thing.
Is that just kind of a little bit of a correcting a dislocation that we're seeing? Because as you talk about weakness in this manufacturing sector, looking at a 110 handle on euro dollar, it feels like the pricing you're seeing is not aligning with the fundamentals that you're laying out. And I'm curious how much of the Japanese story still functions as a hedge, given almost the elimination, or what we're expecting to be the elimination of the carry trade.
Well, so I think it depends on why you invest in Japan. Do you invest for transformation, productivity, some of the consumer recovery?
Well, why would you invest in Japan?
Exactly.
You tell me.
Exactly. Those are the reasons why we like. We see some good consumer companies. We see some interesting financials. We see some interesting technology companies. Small cap. Japan is a big place for small cap, and we find a lot of attractive opportunities there. I'm not talking about leverage and carry, and because this is something that I would say is not something that we do in equities.
Sure.
Okay. Going to wrap that up. Great to see you.
Thanks
for stopping by to see us. Really appreciate it, as ever. Virginie Maisonneuve, Global CIO for Equities, joining us from Allianz Global Investors. Let's talk about what is happening with the markets right now. I think we are waiting for Jackson Hole. There's a few pockets that are quite interesting, though. The chip story out of Germany. Ollie was bringing us that story a little bit earlier on. There's quite a lot of activity yesterday in the chip space as well. As you say, quite a big recovery coming through towards the back end of the session.
Yeah, and this was something I think that follows on yesterday's session over in the States as well, simply because we did see the likes of AMD, NVIDIA, and others rally. Some of that was deal news as well, kind of feeding into it. But this morning, you're seeing the likes of Infineon, for example, higher as well, higher by 1.5%. So the entire chip sector here, a little bit of a catch-up trade to what we're seeing in the States, perhaps some of the fundamentals as well.
But ASML, in terms of where we're seeing the points kind of being added in terms of the European performance this morning, at least on the Stock 600, you've got ASML, SAP's in the tech space is in there. Let's call Schneider part of that tech story as well. ASMI, some big names towards the top end of the market. So tech definitely doing well. Luxury's performing as well quite nicely. Bit of an AI trade in there as well. So Europe's looking okay, and certainly we're well off the lows earlier on in the session. It's not by much, but we're off the lows. Anyway.
A little bit of a defensive trade in there.
OK, maybe. We're coming back a little bit. The rally continues. The German Chancellor Olaf Scholz visiting the site, of course, of the new $11 billion semiconductor plant in eastern Germany. It's near Dresden. The facility, 70% owned by TSMC. It's in partnership with several European chip makers as well. Ollie Crook's here with the details on that story. Ollie, we talked to you a little bit earlier. It's an exciting day for Germany. Why Germany, though? This is my question. Why is this plant ending up near Dresden.
Yeah, listen, Guy. Well, listen, as we talked about a great deal in Germany in terms of we've had the huge wealth generation mechanism in Germany, which has been the past dominance of industries like the auto sector, chemical sector, all of those sorts of things. All of those have been basically called into question in terms of the future and the slow decline. The question is, where does the growth come from? And the answer for many of the people within Germany and the government increasingly is from the chip sector. They've already got a massive chip company in Finland that operates in Dresden and Saxony. They are now also adding to that with huge amounts of subsidies. They're giving 5 billion euros just to build this plant for TSMC. They're giving 10 billion to Intel. And it's important to bring TSMC into Saxony, into sort of so-called Silicon Saxony, where you have the center of all of the sort of silicon production within Germany, because they do much more advanced chips. They do the most advanced chips in the world. And so if you start adding production of that kind to that sort of ecosystem, it starts to build it out in a significant way and in a meaningful industry for the future, because obviously you need that infrastructure, you need the companies there, you need the labor force, and you to build all of that out. And the Germans are really putting a lot of energy to attract that talent down into Germany, and particularly in Saxony near Dresden.
But put this into the context as well. You talked about this in Germany relative to the rest of the world that's also very involved in this chip race. How are they doing?
Yeah, well, listen, they're still pretty behind, all things considered. I mean, they still would like to attract more and more people. They're doing so with TSMC and Intel. But it's really important for them not only to have a sort of future-facing industry, but also to service their current industry, right? Cars take a huge number of chips. The EVs take even more of them, more than twice as many as internal combustion engine cars do. So they need to build all of that out. So for them, it's a high priority. Ursula von der Leyen's there. And for the EU, they want to build 20% of the world's chips in the next sort of 5 or 6 years, which is probably almost impossible. But if they want to hit even a fraction of that, they're going to have more and more projects like this, and they're going to have to potentially subsidize them, because we know that it's happening in the United States, we know what's happening in China, and Europe wants to be competitive and have its own domestic production.
That's why Taiwan has been so successful. Very close relationship between government subsidies and what has been happening with industry. Ollie, great stuff. Thank you very much indeed. We're looking forward to the coverage throughout the day of the opening of that plant. Let's talk about some of the stocks that have been moving here in Europe this morning. BT under a little bit of pressure. That's why the London market is in some ways something of a laggard. The reason for it looks like Sky is going to be going with an alternative vendor for the backbone for its broadband network. BT down by nearly 5% on the back of that. But the real weight in London, Kriti, is the oil story.
It really is. You're seeing Shell from an index contribution perspective down a whopping almost 2%. BP in line with that, together making down about 17, almost half of just those two companies, half of the move that we're seeing lower in the FTSE 100. So red on the screen, but let's see if it kind of comes back. Maybe this is just a little bit of a amplifier effect of what we're seeing in the macro.
We're going to have to watch the geopolitics. We're going to have to see what happens in and around, obviously, what the story is with Gaza, what happens in the Gulf as a result of that, what Iran does as a result of that. So there's a lot of moving parts here. But the real kind of break on the oil story has been what has been happening in China, and that has continued to act as a break, which is why I haven't seen upside maybe when it comes to the oil price when we get worse news coming out of the region. Anyway, let's talk about what's next. The Pulse is coming up. Francine Lacroix on deck. This is Bloomberg.